Hello and welcome back. I'm Natalie MacDonald and you're joining us here at SuperReturn Asia 2016. It's my pleasure to welcome into our studio Peter Fuhrman from China First Capital. Peter, thank you so much for taking the time to sit down with us today.
Delighted.
Okay, so let's jump straight in then. We're looking at China's economy and it's gone from being world conquering, let's say, to really now slightly more feeble. Why is that? How are you picturing this at present?
Well, why that's happened, I think probably most people who will be looking at this will have some ideas about the overwhelming pressure that's now on China's economy to change the formula that it used so successfully to outperform any economy in human history. In other words, it's really worth reflecting how far they've come in 35 years, and that's been a remarkable achievement. But all the triggers and methods and tools that they use to get there don't really have any application any longer. So it can't be export driven, it can't be government investing and building infrastructure, because they've done all that. So what China most needs is what we call a new growth driver. Is something that now can transition them away from a model that is done greater for any single country and any large number of people than anything, again, as I'm saying, in human history. It's lifted at least 800 million people out of poverty in our lifetimes. Wonderful achievement. How now to bring them to the next level of middle class satisfaction is a challenge, but they're moving in the right direction. It will be more difficult, as it always is. The older you get, the problems get more complex and more difficult to solve. But I do fundamentally have confidence. Why? China has, if you want, the world's most valuable natural resource in abundance, and that's entrepreneurial ambition and talent. So as long as China remains reliant on and friendly to all that enormous entrepreneurial talent that seems to spring up naturally in the Chinese-speaking world, I have a lot of confidence they're going to continue to perform well.
Is there more then, in that respect, that government could be doing, or are, as you mentioned, they kind of on the right path to that?
Well, let me take it a slight, maybe take a different take than most people say about the government's role. So sure, the government is a very active participant in the development of Chinese economic policy. Everyone is very familiar with that, comfortable that they follow a what we call technocratic approach to central government management. It may well be, though, that we're entering a phase where the government needs to, in fact, counterintuitively and against all practice and habit, pull back a little bit. They are so wealthy. They have so much capital to either favor or then disfavor different sectors of the Chinese economy. It may be in danger that they're trying so much to help that they're not providing the adequate cure. It may be that a little more government inactivity in China would actually achieve better results.
I mean, even when China's economy was growing twice as fast, it was still difficult for PE and VC firms to provide that money to their LPs. Now, if we're seeing a slowdown in the tiger economy, does that become even more complex?
Yeah, absolutely, and I would encourage anyone who may have the time or the inclination to pursue a PhD on the side to think about and try to understand how it has been that China, really since the PE industry got started there in about 2005, the economy overall has grown almost fourfold. And yet PE and VC results, particularly if measured by capital return to investors, have barely been a fraction of that. So everyone has always understood financial theory teaching us that investment returns don't always correlate well with GDP growth, but never has the gap been so big. So it certainly poses an important challenge, and I would say one that will take a lot of new thinking to solve, which is if the overall economy is doing phenomenally well, companies therefore overall are growing very quickly, but very little ends up being captured to the benefit of investors, how much more challenging it becomes when companies and economies are growing slower. So I would clearly suggest that PE and VC needs to think in new ways, because what always appeared to be China's fundamental selling point, which was the high rate of GDP growth, the rise of a consumer middle class, the increasing reliance on the private sector against the public sector, all those are true, all those have become themes that investors could look at and put money behind. The challenge has been, why am I not seeing the phenomenal returns that one would expect in that environment?
Well, in terms of that, gaining return on investment, are there sectors that are being perhaps overlooked then by investors?
This is an inevitable part of China because it changes so quickly that anyone who suffers at all from motion sickness should not think about or participate in the Chinese economy. It just changes at light speed all the time. So sectors go in and out of fashion at a time frame that no one can find corollaries with in the rest of the world. At the moment, we've moved just in the last few years, in fact, from a heavy reliance on investing in what were traditional manufacturing companies to a situation they're completely out of favor, and now almost all flows of capital are to technology-based solutions, both to serve the consumer middle class as well as to serve the healthcare industry. So we've really now seen mainly capital being deployed in a smaller and smaller number of sectors, with a larger number of sectors out of favor. And I guess as someone who has a somewhat contrarian mindset, that would tend to suggest that maybe the best opportunities going forward will be in those areas that are not seeing this enormous tidal wave of interest and capital, because that inevitably results in valuations being bid up to unsustainable levels, and that it therefore becomes that much harder for investors to get the rate of return they need. So yes, there are sectors that are highly popular, highly in vogue, and yet counterintuitively perhaps some of the best opportunities for investors on a risk-adjusted basis will be precisely not in those areas. One needs to shop carefully.
Peter, thank you so much for taking the time to chat with us today. Really appreciate it.
Pleasure. Thanks very much, Natalie.
No worries. That is all we've got time for right now, unfortunately. You can gain more interviews with our industry insiders and get some of their thoughts and analysis on some of the trends and topics emerging from SuperReturn Asia 2016. I'm Natalie MacDonald. Thanks for watching.